Hey folks, it's ASIM Trading coming at you with a quick video. My PhD classes ended on Sunday, so I have a week-long break to sit here and do nothing but make content for you guys. So isn't that great? So what I wanted to do is, I've talked about a lot of concepts in my X posts and in my videos, and I think a lot of newer traders, they get kind of overwhelmed because there's all these different traders that have all these different methods and the way that they do things, and they start to lose the forest for the trees. They get kind of like hyper focused on specific techniques and strategies and things like that without understanding, like, overall, how does a momentum move unfold? How does as Mark Boucher calls them, runaway markets, how does a market run away kind of out of control? And what does that look like? And where do you get into a trend that's quote unquote runaway? I've talked about things like Stockby's momentum burst and his anticipation setup. Like, if you want to go back and review that, just look at the criteria here. Pause the video if you need to, if you've never seen this before, and just understand, like, what does a basic momentum burst look like? What is a momentum burst? How do they originate? How do they set up? What do they look like before, during, and after the breakout? I've talked about this concept in depth. I've talked about the AD excellence concepts. The two main setups that I use from Dr. Schaap out of this AD excellence power trend strategies is the AD Express and the AD Extender. And essentially an AD Express is just, you kind of have this upward thrust. And he uses the ADX and the DMI indicator to help him identify these setups and to scan for them. But essentially you just have this upward thrust. If I just looked at the price action, you have this upward thrust of price. And you have a consolidation where the ADX continues to trend up, but the short-term plus DMI kind of pulls back because the price action isn't thrusting up as strongly. You kind of get this consolidation. And then the consolidation is short, so like it's not enough time passes to where this ADX trend kind of like rolls over. So essentially you have an uptrending ADX and you have a short-term downtrending plus DI, which kind of creates this 3 to 4 day stutter step. And then when it breaks out of that little shelf, that's the AD Express pattern. And the AD Extender pattern is similar. It's just, rather than this ADX line continuing to go up, the pause or the consolidation is long enough and deep enough to where it actually rolls the ADX line down. But this plus DI remains above this negative DI. So you can kind of see there's this gap between this bottom line and this top line. So you have this upward thrust. You have a consolidation which is long enough to cause the ADX to roll down, but not enough to cause the plus DI to go below the the minus DI. So that's the AD extender pattern. And you can see it happens again here. There's a thrust up, there's a consolidation as the ADX rolls down, but there's still this gap between these two lines. And you can see, like in this one example of TIVA, there's multiple examples of here where the stock pulls back to its rising 20-period moving average. You have these down slopes of the ADX indicating that there's a pause or a kind of a lack of momentum. But the integrity of the trend still stays in place. There's lots of places to get into this thing. So I've talked about these concepts in depth in my videos and in my posts. I've talked about Kulamagi's strategies quite a bit. His flag patterns are quite useful strategy. He's not the first person to come up with a flag, certainly not. Flags and pennants and all these things have been around forever. He just exploited them and learned how to trade those patterns and identify stocks, momentum stocks especially, that are showing these patterns. So I've talked about Kulamagi flags. I've talked about Dave Landry pullbacks, which again, it's the same thing. There's an up thrust, there's a pullback, and then there's as the stock emerges out of that pullback, you enter it and then you ride the trend. I've talked about these strategies in depth. These are the backbone of everything that I do. Is some variation of these. It's a momentum burst. It's an AD Express or an AD extender pattern. It's a Kulamagi flag. It's a Dave Landry pullback. Like, I didn't create any of these things. I've just borrowed them from traders who've been in the trenches for decades, and they've studied price action. They've studied the biggest moving stocks in history, and they all came away with remarkably similar conclusions. And then I've talked about Kale's cycle of price. Go watch his videos, go buy his book, buy his course. He explains these things in infinite detail. He talks about the basic price cycle that stocks will go through, and then strategic points where you can get into these stocks, and to maximum reward to risk. I've talked about professional trading strategies and the core buy and sell setups that are in that book and that course. And again, you see a lot of the same sort of key players. You see a buy setup, you see this double bottom retest, you see this flag and triangle. These folks didn't sit in a room and talk about these things. It's just these folks have, in their own way, have studied price action, and they've again come to remarkably similar conclusions. What people do though is they sit here and they get wrapped up in the weeds of these different patterns. And then they kind of hand wring of which one's better than the other, and this trader versus that trader. And the thing that they're failing to understand is, how do you put this into just a basic life cycle of a runaway move? If I take all of these different things that I just talked about, all these different concepts, I can easily build a model of the strategic entry points to get into a stock that's in the beginning stages of a runaway move, just by taking all and synthesizing all this information from all these different traders. You can quickly come to some very logical conclusions about where you should enter, and how you should manage these positions on these momentum trades. And so essentially, where this all starts is if you look at any of these traders, a lot of them, even if you talk about O'Neill and the cup and handle and the flat base, and a lot of those longer term patterns, essentially what they're initially looking for is some sort of gap or some sort of expansion out of some long sideways consolidation, because that's signaling some sort of change in major direction of the trend. So there was some stalemate, and you can imagine this is a sideways consolidation. You can imagine it. There's, you could also see a downtrend like this, where you kind of stair-stepping lower, and then there's some sort of impulse bar that breaks that downtrend. Typically, the flatter the base, the better that is. You really don't want to be trying to buy these sort of impulse bars off of nosebleed downtrends. You get a lot more stable sort of action if you do it in the context of some sort of sideways consolidation. And so what actually initiates a runaway move? What actually initiates a momentum move? Most of the time it's going to be a gap or some high volume breakout. So out of this range or out of this downtrending action, there's going to be a gap, or there's going to be some sort of expansion. So obviously a gap, let's say this is the range, a gap, there's going to be a space or a gap between the highs of this range and the lows of the bar. It's going to gap over all this price range, and that's what is going to initiate this sort of move. Or if you can imagine a high volume expansion bar, if the price starts closer to this breakout level without gapping, but it still is expanding in price and volume as it breaks out, that could be the other way that this trend gets initiated. So that's typically the very first optimum time to buy that move. A lot of people try to buy it while it's slopping around in the consolidation, and there's no guarantee that it's ever going to break out. It could just as easily continue its downtrend. The reason you wait for this impulse bar is because it's signaling a change of the trend. And whether that's a gap or whether it's an expansion, there's usually within the first 5, 15, 30 minutes of the session, you're going to usually get an entry to where you can get into that gap or get into that expansion bar. And so think of this as day one, the day one impulse bar. Your first opportunity to get into that, if you're not trading pre-market, is to get it after the gap or on the expansion. And then another opportunity that could arise Could be like intraday, there might be some sort of pullback on the 5 minute or the hourly or something like that. It might pull back, and you might get another sort of entry. Or if you happen to miss the gap or miss the initial breakout, you can get it on some sort of pullback. Because sometimes the first 5, 15, 30 minutes, like the range of that initial bar is extremely large. So it's really hard to set a good risk reward ratio sometimes. But in some cases, just by waiting a little bit longer, you can get a much tighter risk reward, not significantly above the cost average of where you could have gotten in if you were to buy the breakout of a 5 minute or a 15 minute candle. And as I look at the professional trading strategies, this is what they consider like a level 1 gap, which they consider like this is the premium kind of gap. You're gapping over a wide range red bar, which they have here, which creates huge shock value and short covering. Gapping over multiple pivots, so you can see there's like a pivot high here, 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 here. So this thing is gapping over all of this sideways range over multiple pivots. So you can imagine this little craftily drawn base that I drew. These are kind of pivots. So this thing would be gapping or expanding over multiple pivots that have been formed, clearing just enough through the prior pivot highs. So when he says just enough, it's like it's just clearing the pivot. It's not gapping way the hell up here and then all the pivots are down here. Because if there's a massive gap between the base and the gap, those often end up being situations where things reverse, and they're not as reliable. That's not to say that those larger gaps aren't tradable. It's just that they tend to be less reliable than ones that kind of gap a little bit smaller and kind of just above the pivots, and then into the void with room to move higher. Essentially, like there's all this white space to the left of the chart. It's not like it's in the middle of a downtrend. Again, like for professional trading strategies, a level 1 gap, there needs to be kind of some clear blue sky above the base, and it's not gapping into a bunch of overhead resistance. And then he talks about like relative strength relative to the market. But again, like this is just professional trading strategies, how they define what a good gap looks like. And if you kind of think about an expansion breakout, it's going to be pretty similar. There's going to be a wide range bar. It's going to be expanding over multiple pivots. There should be void and kind of blue sky above for that way the stock can run without having a bunch of overhead resistance. Like and relative strength is important. All those things, whether it's a gap or whether it's a high volume breakout expansion, those things all apply. So again, as we start the impulse, as we start the beginning stages of a breakaway or a runaway move or a momentum sequence, it's typically going to start in this way. There's going to be a gap or a range expansion on really high volume above some sort of basing area or downtrend or things like that. That's going to be your first opportunity to get into this trade. And then sometimes, and this doesn't always happen, but like sometimes you'll get day 2 follow through. You'll have this big kind of shock impulse bar on day 1, and then day 2 is a kind of an expansion of that. Like this momentum carries over into the next day. So sometimes you'll get this kind of like run of like several days in a row. Even after it's made this big move, it'll still continue to run. So that's another opportunity where you can get a pretty tight risk if you just kind of get it as it's moving above the first day's highs. You can almost use that the low of that day as a quick stop. And the sequence, as I'm explaining here, doesn't always unfold like this. Like you might get the impulse day and then you immediately go into your pause days. You might not get 2 or 3 days of expansion. So again, this is just a theoretical model that's just based on how price action tends to unfold, just to kind of give you some guide rails of what to expect. So this is kind of where we get into the AD Express territory. Like I said, AD Express is where you have this impulse and then you have some sideways chop and slop for a couple of days, and then that breaks out and then it continues. So this sort of action here in the model, and depending on the trader you talk to, it could be 1 or 2 days, it could be up to 3, 4, 5 days. It's just kind of this short-term pause where the price action gets tight, the volume dries up. And then what you're looking for is a breakout above that range, and which kind of kickstarts the next leg up. So again, like you have this initial impulse above the larger base, this is the initial breakout. And then at some point you'll have a couple of days of consolidation. 3 to 5 days is usually pretty optimal for this sort of 80 express pattern. And then you'll have a breakout of that pattern if this continues. Again, like this is a big if. Some stocks might have this initial impulse and then they'll roll over and die. So that's why you're waiting for the breakout, because you don't know if out of this consolidation, if this thing's ever going to break out. It might not ever break out at all. It might have this initial impulse and then it just dies. There's plenty of times where you'll see this, where you'll have this one day kind of one hit wonder where it has this big move on one day and then it just kind of falls apart and never actually follows through. And that's kind of the key here. The key to isolating strength is looking for things that follow through. I want to see follow through from the open. I want to see follow through from that initial day. I want to see follow through from that first initial consolidation. That's where you kind of identify these stocks that are strong. If it pulls back too far, too deep, it just indicates that initial burst of strength it's not there anymore. Whatever buyers were present to push this thing up, they've kind of disappeared. And so as this runaway move unfolds, or this momentum cycle unfolds, you might have a couple of these 1 to 5 day pauses on the way up. This happens quite often, where the stock only rests for a day or two and then it bursts up again, and then it rests for a day or two and then it bursts up again. But often at some point you're going to have this much longer sort of pullback. So I have the rising 10-day here. I mean, this is where you kind of see these 10 and 20 period moving average pullbacks, which are much longer. And again, this is where you get into like the Kulamagi flag patterns. You see this 10 period here on the chart. You kind of see the price not only touches it, but it kind of surfs it and grinds into that, and then it breaks out. It touches and grinds and breaks out. Like you'll start seeing the higher low pattern. So as the stock gets supported by the 10-day, because what institutions do is they'll use this weakness as an opportunity to accumulate shares. So you'll start to see the lows of the pattern start to get higher, the highs start getting lower, and you kind of see this compression. So you can almost think about it getting squeezed from the bottom and getting squeezed from the top as sellers sell it, as it rises, and as the buyers pick up shares on the way down, you start getting this nice compression pattern. And during this compression, you'll see the volume dry up considerably. And again, whether we're talking about the Kulamagi flag, whether we're talking about the Dave Landry pullback, whether we're talking about the 80 extender pattern, it's all talking about the same phenomenon. You have this initial burst up, you have this sideways consolidation. It's nice and constructive and orderly, and the volatility compresses, the volume dries up, and then you have this expansion back through the top of these of the range here that kickstarts the next leg of the trend. Again, all I'm doing is taking the concepts from all these other traders, and I'm just building a model of like, what does a runaway move look like from start, and step by step and all the way through. Because if you understand how price action unfolds, if you understand how momentum moves unfold, you'll understand how these traders came to these conclusions. They didn't just make this up. They just studied enough stocks. They studied enough examples of momentum moves to be like, oh, like this is a pattern that I'm going to create, and I'm going to build rules around it. But essentially all they did was observe just the supply and demand dynamics of a momentum sequence, of a runaway move. Again, these traders call it different things. They have their own vernacular, their own little nuances and techniques that they use to get in these trades, but essentially, like, they're looking for very, very similar things. That's, I guess, the one benefit of being a PhD researcher is I learned how to take a whole bunch of information and synthesize it down to like a basic model. And so just me over the last 20 years just studying tens and hundreds of top traders, and just trying to understand like what are the inner workings of their system. You start to uncover commonalities, you start to uncover patterns. And so that's how I even built this sort of this runaway model, just based on studying trader after trader after trader, whether it's Kulamagi or Minervini or Stockbee or Dave Landry or like any of these guys, Mark Boucher, and I posted that today about the TBB LBG. And that's kind of a confusing acronym, but if you kind of take a step back and think about it, all that these short-term patterns are showing is extremely strong demand. On a thrust breakout, the price bar is expanding two times or more greater than the average daily range. It's like a very large expansion of the range. It just means that the buying demand is very strong and the selling demand is not very strong because the price is being bid up very strongly with the demand. Same thing when you see this breakaway lap and breakaway gap. Like these are just kind of, you can think of a breakaway lap as like a mini gap, and then a breakaway gap is kind of a larger gap where it actually gaps above the range. If I had to move this price action, so like this right here would be like a breakaway, a thrust breakout. Breakaway lap would be like it's kind of like a little mini gap. It didn't clear the whole range, but it's kind of like it's still gapping slightly at the open. Whereas like a straight up gap is going to be more space between the bottom of the gap and the last price action. But all these things are indicating is strong demand, where investors are willing to like gap the price up or trade, buy higher prices and keep bidding this stock up in the midst of a breakout. And what Mark Boucher found is that like these signals, these sort of price patterns, are all throughout a runaway move. So what he wants to see is like this first thrust up. He wants to see 2, 3, 4, 5 of these sort of patterns inside of this initial up move before it flags out. Because his thesis is, and based on studying lots of different stock moves, he found that stocks that had these characteristics in the first third of their move, there was a very strong indicator of what was going to happen in the next 2/3 of the move. So his whole goal was to identify these patterns, these kind of signs of strength in the very early stages of an uptrend. But I mean, his strategy was to wait for this particular flag, wedge, or triangle pattern. But as I've said, other traders have found and successfully traded things much earlier in the cycle. You can start trading the cycle down here. This is where you're going to get the greatest risk for reward. But it's also, this is the most unreliable part too. There's lots of false breakouts. There's lots of false gaps that reverse, things like that. So just because something has an initial impulse move doesn't mean it's going to lead to this sort of move. So by waiting, you get more confirmation and you get more reliable patterns, but you also miss some of the best parts of the move. So it's kind of a trade-off that you have to understand of like what is it that you're trying to get? Are you trying to increase your reliability, or are you trying to maximize the move? Because those are things you have to consider, is where in this cycle do you want to play and where do you want to focus. If you want to focus on gaps and you want to focus on these high volume expansion breakouts, that's a totally viable strategy. I think it would work really well. But you have to understand the trade-offs to this being your starting point. Another approach is you could wait for some of these other patterns that emerge after the momentum is clearly in place, because down here the momentum is starting, the impulse is starting, but there's a lot of these that fizzle on day 1 or day 2, and it never actually reaches. It'll never build a flag, or it'll never give you a nice 1 to 5 day pause with a breakout. So those are the things you have to kind of weigh. And also sometimes it's really hard to get a good risk reward buying it on the gap. Whereas if you take these tight patterns, you can get a very nice tight risk reward and very large upside for that risk. So I guess to summarize what I'm trying to say here is there are, based on all of my studies of like many top traders, there's key strategic points where you can get into a stock that's in a runaway sort of move. You can get in the very early stages, either on the gap or the expansion breakout of a larger consolidation breakout or gap. You can get in, right near the open, or maybe try to get in at some sort of intraday pullback or intraday pattern or consolidation. Or you can do both. You could try to get some on the initial gap and then maybe add to it on day 1 if it continues to act well. And you can maybe add to it another time if it follows through from that initial impulse bar. You can add more. Or and this is Jeff Cooper from Hit and Run. he actually had entire strategies around day two. Like he would use day one just as a way to find stocks that he was interested in, and he would actually trade starting from day two. So people that think, oh, like I missed the boat, this is too late, it's like, okay, Jeff Cooper didn't think so. He wrote two books on it, Hit and Run 1 and Hit and Run 2. Several of his bread and butter patterns are basically trading the day two expansion from a day one impulse move. You have multiple strategies that target breakouts from these pause areas, and then you have multiple strategies that target these sort of flag and wedge and triangle breakouts. So again, it's like pick your poison. You can either focus on one of these, you can focus on gaps. Kulamagi, I think he mentioned in recent videos that his main focus lately has been on gaps. Even though like he's made a lot of money trading flag patterns and other things like that, but like he's kind of indicated that he really likes trading gaps because it's less work. They're much easier to identify, and again, you get the maximum risk to reward ratio here. And that's not to say that flags don't work anymore, that they've stopped working. It's just it's a different mindset. It's like you're choosing to trade a different part of the cycle. You could trade nothing but express setups and just trade these 1 to 5 day pause breakouts. Like you could easily do that and probably make a lot of money just doing just that one setup. You could just trade flags and wedges and triangles and just trade that one setup and make a lot of money. You could just trade gaps on day one or expansion bars from day one breakouts and make a lot of money. Or you could do a combination of these. You could have a small starter and then add and then add and then add, and like you could have a very sizable position by the time you get to this flag or wedge or triangle breakout, if it ever makes it that far. And that's the thing you have to keep in mind. This cycle is, if you study just about any successful momentum move or runaway move, it's going to unfold in a very, very similar fashion to what I've described here. And all that these other traders are trying to do is just codify and capture their observations of this same sort of cycle. Like I said, just because they call it something different, they name it a different pattern name, or they have their own vernacular, that's just their way of kind of like putting their name out there of like, oh, look at this interesting thing that I developed. It's this new novel concept. Honestly, none of this is new. Supply and demand and price action is as old as the market. It's just these traders, over time, they've studied the market enough to observe these same phenomenon. They just happen to call them different things because it's not like these guys work together, you know what I mean? So I hope you found this to be helpful. If you're a newer trader, I would focus most of your energy on one of these setups. I would not try to do all of these setups at the same time because you're going to not do very, very well. I would focus on, maybe starting with gaps and understanding the nuances of gaps, or starting with these kind of the breakouts of these 1 to 5 day pauses, or start with flags or wedge or triangle breakouts. But I wouldn't try to do all of these at once. As you gain experience and you gain confidence with one pattern, then maybe you expand it to two, or maybe at some point you can use all three of these in conjunction with each other to kind of do almost like a position building strategy, where you kind of start small and you just add as the thing moves on, and you'll have some very sizable positions in some of these very runaway moves. So I hope you found this video to be helpful. If you did, like and subscribe and leave a comment, and I'll try to get to you. I don't answer a lot of questions lately because I'm busy with my PhD studies, and that gets pretty intense. But I try to do the best I can to answer questions whenever I have the time available to. But thank you, and I'll talk to you guys soon.